Hi, my name is Kunal, and welcome to the Geeks of the Valley podcast, which connects with some of the brightest minds globally who are leading their respective industries today to discuss the hottest upcoming industry trends and how their work is affecting the global economy. This morning, from the San Francisco Bay Area, we have a very special guest joining us, the ex founder of Pureland and the Health Nest Fund. Please welcome the current partner of TCL Ventures, Jay Zhao. Jay, thank you so much for joining us today.
Hey, thanks for having me.
And how are things with you in light of COVID?
Things been good. Like most people, we just live on Zoom nowadays and hopping on different calls. It's definitely taking longer than everybody expected, but we're just trying to make the best out of it. So things are going good.
So let's jump into the first question here, shall we?
Yeah.
Tell me about yourself and your background and how it led you to the path of becoming a CVC for a cross-border China-US fund.
Yeah. So it's interesting because I got asked this question quite a lot, which is how do you become a VC? I've been fortunate to be a career VC over the past 10 years in in tech investment at two different venture funds in the Valley. One is at Granite Ventures, and the other one is Walden. Both are very well established fund in the U.S. With the presence in other parts of the world, like China, like Israel. So uh, over there, I kind of just learn and really step up to partner with founders um, in the US. Companies like Anaplan, Makeda, and HireView. Some of those are more well recognized in the enterprise space. So these two fund experience really taught me two things. One is how to be a true partner for early stage companies, and two is how to identify and be analytical about the bigger market trend. Which apply to some of the things that we're doing at T Fund nowadays. Um, so to answer your question, it's kind of like not by plan in a way, but definitely enjoyed every moment spent on those different funds.
What a background, Jay. And as the current managing partner of T Fund, aka TCL Ventures, what is the fund's size, investment philosophy, and ticket size?
Yeah, so T Fund was set up by TCL, which is a consumer electronic company in China. So about 2 years ago, TCL was really thinking about how they can establish and expand the global investment practice in a more systematic way. So at that time, I was coming out of Walden, and I was actually thinking about starting my own fund. So we kind of just click because we share the same passion for investment focus. We like some of the philosophy in terms of helping entrepreneurs by partnering them with the corporate resources and really to help these companies succeed. And we can talk a little bit more about that, like how do you balance the CVC program and and the startup. So the fund is $100 million fund, and we really set out to invest in AI, enterprise, and deep tech companies. So for each investment that we do, we typically write first check between $1 to $5 million, and that's a sweet spot that we target. And we don't just limit ourselves in the U.S. We also invest outside the U.S. For example, in Israel and also in China. So T-Fund has been really great platform for us and for me personally because it really provides a global perspective in seeing different innovation happening at different ecosystems. So that's kind of like the backdrop of T-Fund.
Right. And to dive a bit deeper into this, Jay, what are some of the verticals
Yeah.
the fund really focuses around? What is it that you're proud of with this fund?
Yeah, so it's pretty much a continuity of my previous investment thesis. So when I was at Granite and at Walden, one of the big focus is uh, in enterprise software. So it's very interesting to see how enterprise software specifically evolved with different underlying technologies, right? So if you look at the history of technology evolution, we're seeing from the 1970s, 1980s, you coming from IT IT infrastructure. That's kind of where the enterprise companies most build on. And then comes the internet, and then comes cloud, and then mobile. And now we're seeing this new emerging trend of AI automation. So the enterprise workflow or enterprise productivity software is one of the major things that we spend a lot of time in. So break that down. What does it mean? That means how do you generate more sales lead for modern enterprise, and how do you cut costs in terms of unnecessary uh, spending or expenditures within enterprise operation, and how do you make better decisions with better business analytics. So from the time at Granite, the early enterprise software company called Siebel System was one of the kind of more well recognized name back in the 1990s. And then and then there's Salesforce, and then now we have Slack, and now we have Zoom. So each generation of enterprise software companies really evolve with underlying technologies. Um, but to answer your question, that's one of the big area that we spend a lot of time on. And it's also one of the areas that we think we can be helpful to startups because we can pair them with the corporate TCL in terms of synergy, in terms of getting the startup to become a pilot partner to the enterprise, to the big companies. And then there are other two verticals that we spend time on as well. One is smart manufacturing or industrial applications. So that evolved a lot of again, a lot of AI and a lot of computer vision. That's the underlying tech. But more importantly, when it manifests itself into vertical applications, then we look at robotic companies, we look at warehouse solutions, we look at supply chain logistics solutions. How does the product really benefit modern companies in terms of saving cost, in terms of increasing productivity? So the only difference is that the second category, the smart manufacturing, will have a tighter integration with hardware, with physical product form versus the pure software form. And the third part is digital media, because TCL has a lot of a screen that include mobile phone and TV and all that. So we also look at a lot of digital media companies that can be loaded into those screens. So in that, we provide additional distributions to startups and to companies. And you probably noticed the news right lately. In the digital media space, there is AI impact on this space as well. I mean, the biggest example and the high profile example is ByteDance. So they really disrupt the whole media space by using AI algorithm to increase the efficiency matching people and information, which is super interesting. And we'll obviously we'll look for companies in that category with a similar characteristic matching to the AI automation thing as well.
So, Jay, before I dive into your thesis here, right, there was a really good point that you brought up on new media and digital media, right, about
Yeah.
ByteDance. But now
Mhm.
there's this whole overarching thing about kind of ByteDance, TikTok, and you know uh, what is going on there, right? And so,
Mm.
what is your take on the situation currently on how it's kind of snowballed into kind of a whole political thing?
Yeah, I think the politics is or geopolitics is really hard to predict, and that's kind of the biggest wild card over the past, I would say, 2 or 3 years, globally speaking, and also between China and U.S. Um, I we'll see what happens. I mean, I think right now it's ongoing situation with ByteDance and the TikTok global. Um, but the question is that should investor be concerned in the future? um, Companies like ByteDance won't be able to grow to a certain size because the restriction that imposed on either side, either by China or by US. Um, I think that's a good question. I don't know, but one thing that I think is pretty certain right now is each geography want to have their own ecosystem, own startup ecosystem. So over the past 5 to 10 years, that would the popular mantra in the valley is that the internet is open, and we try to connect everybody, and that's a great thing, and that had a great run for a while. But I'm afraid that over the next 5 to 10 years, you're likely to see each major ecosystem become more isolated. With China being on its own, US is going to be on its own as well, and Europe is going to form its own ecosystem. Maybe with a combination of its own domestic companies plus some U.S. companies or Chinese companies in the mix. I think it's easy to be pessimistic about the landscape looking like that, right? Looking into the future. But I also think it presents a very interesting opportunity for startups and for investors, especially in the enterprise space. Now, for the consumer space, I think ByteDance, let's take out TikTok for the TikTok consideration for a moment. ByteDance in and by itself in China is already a big company, is already big, has a big business, and they're gonna be fine. Just living on that China market, on that soil. And in the U.S., I expect we'll see something similar that's taking place. Although it's going to be harder because the timing is not as ideal as, let's say, 5 years ago. But it looks like it's an inevitable trend that these major ecosystems are more separated and then more isolated in a way. So it's a deep topic that we can expand a lot on. But for now, I think we're in the midst of it, so it's hard to tell. But the bigger trend seems to be pretty certain for now.
Jay, that's a very good point that you bring up. In regards to now jumping deeply into this thesis you wrote on AI automation and how it could be the new industrial revolution or how it's already happening, right?
Yeah.
You spoke about in your thesis how AI automation can materialize itself into multiple forms of products, right? New product
Yep.
category that you mentioned, scalability and efficiency and efficacy.
Mm.
Can you speak a bit more to this?
Yeah, absolutely. It's a good question. So I recently wrote an essay or post about AI automation. I think it's interesting because as an investor, we in a way kind of like historians because you really have to study the past to understand the present and the future. So if we look at the past, right, there are few major tech breakthroughs that happened, right? One of it is industrial revolution, where humans know how to use steam engine and convert one form of energy into productivity. So right now, with what we're experiencing, I mean, we already experienced a different megatrend before in the tech space. When we talk about the internet, mobile, cloud, and now I think looking over for the next 10 years, what's going to happen? What's the major thing that's going to take place and drive innovation? And I think the conclusion is AI automation. So AI is not a new term. I mean, it's something being around since the 1960s. But a few things that happened over the past 5 to 10 years that really contribute to the tipping point of where we're standing now. The drastic low cost of cloud computing and the abundance of data, and also the sensors and algorithms that make AI automation or AI accuracy is much more accurate at the production level that can be applied to commercial use. So in a way that we try to understand, this investment trend or investment theme, we tend to, kind of draw different framework to help us better understand, how a new company can fit into those framework or how new opportunity can emerge. So from the tech side or enabling tech side, it really breaks down to three categories, as you said. One is what we call the new innovation or the new product. So these are, some examples are, self-driving car or self-driving trucks or autonomous vehicles or things that you see in the news, right? Or voice AI. These are things that that was not possible without the breakthrough of AI automation. And we're seeing it and we're funding it and we're hoping that when you come to the mainstream level, it will create a tremendous amount of opportunities. We're talking about billions and even trillions of opportunities. So that's one category that's fairly exciting. And the second category is scalability. So examples, would be like chatbot or virtual assistants or even facial recognition. These are the software tools that existed before. As programmers, we're able to hard code or teach computers, tell computers what to do when they face or when they recognize certain things. But computers are never able to get to a spontaneous level to teach themselves or use one role and apply to the others to scale, to really scale it up. So now with machine learning, you're able to have a commercialized product that can be sold to different enterprise customers and generate value in that category. So that's a scalability, pitch or scalability selling point. Now the last part is what AI automation will do or enable a new type of software do is to increase efficiency and efficacy. So this is a part that I think is very exciting because it's going to have the major impact in different software players or existing software companies, because we're at the very beginning of it. Before we talk about different evolution paths of enterprise software, from Siebel system to Salesforce to Slack to Zoom, and nowadays we see major funding in the RPA space, like Automation Anywhere and UiPath. But these companies started, not like last year, not 2 years ago, but roughly 10 years ago. So they accumulate a lot of data, they accumulate a lot of customer base, but it took about 10 years for them to get to the sort of like a tipping point to where they are now, where you can use RPA and inject that into enterprise workflow so that the whole enterprise productivity will increase fivefold and tenfold. And that's super powerful. But the bullish side of me looking at this from an investor angle is that we're just at the beginning of it, because there are so many different pain points and different conjunction of enterprise workflow can be increased, such as lead gen, such as CRM, such as customer support, and such as financial planning. Like what's the next version or next AI first version of Anaplan, or what's the next AI first version of Salesforce? I think we don't have the answer yet, but if any disruption could happen that took away the value from the incumbents like Salesforce, like even Microsoft, then it will come from this new trend, will come from AI automation. Now, from these three major categories, we kind of break it down into different verticals. We look at obviously manufacturing. That's one area that's going to have a profound impact, and also we look at fintech and payment, and also IoT, what we call the AI IoT or AI times IoT. Smart speakers kind of fall into that category. But anyway, so that's kind of like the lens or the framework that we use when we think about AI automation companies.
Right. And what I want to do, Jay, is I want to take a deeper dive here into the Gartner's hype cycle, right? And for listeners out there, quickly, the Gartner's hype cycle is a pattern that arises with each new technology or innovation. It's somewhat of a graphical depiction. And right with this Gartner's hype cycle, you have, right, Jay, the five phases, right? The innovation trigger, peak of inflated expectations, the trough of disillusionment, the slope of
Mm.
enlightenment, and the plateau of productivity. With artificial intelligence, what are some of the the unique expectations you're kind of seeing throughout those five stages?
Yeah, I mean, I mean, Gartner's hype cycle is a really a useful framework to think about different life stage of a technology development. And the other framework I will speak quickly, which is very similar to the hype cycle, is Perez's technology revolution and the financial capital framework. So basically, it's a book that kind of talk about how the two parts, the tech revolution and financial capital, are correlated in a way. In it, the book talk about which is similar different phases, right? You're gonna go through for each new technology, it goes through different phases, including eruption, frenzy, and then turning point, and then past turning point, you go to synergy and maturity. So the last two represent the deployment period that we kind of, the general mainstream market will start to accept the new technology, and you will see more applications that's driven and enabled by this new technology. So going back to Gartner's hype cycle, and interestingly, if anyone's interested in taking a deeper dive, you can read my post. It's very interesting to comparing these two frameworks together because they kind of talk about the same thing in the same timeline framework for AI technologies. So over the past 5 to 10 years, I think we all agree that we have seen a lot of capital going to autonomous driving investments, a lot of sensor investments, and frankly, just anything that can be coded with AI, whether it's real or not. And I think that present a big problem. Usually, I'll be worried if when I'm an investor seeing a big frenzy of capital that just rush into one space. You can argue that it was a similar dynamic when VR first appeared or first become hot after the Facebook acquisition. A lot of capital went into the space without thinking too much how long it will take or how big the things will be, or can the company survive long enough to get to that the mainstream stage or the deployment stage. So looking at the hype cycle, you can see that's obviously that's Gartner's viewpoint. So they kind of putting different color coded in terms of the speed of each dot's movement, but you can see like a lot of these AI technology or AI application that we talk about, like chatbots and NLP and edge AI. All those things either are at the peak of the inflated expectations or on the way to get there. Now, do I think now is a perfect timing to make investments? I do. Because we are not investing these AI companies on the way up when they drive up the hype cycle curve, but actually we're going to invest this year and over the next 5 years and be patient about how these technology moves through the hype cycle, because there's going to be downtime. There's going to be a time when the capital is not as passionate, as excited, as in some of the categories that we invested in. But that's okay. That's basically the role of a venture capital. So anyway, so to answer the question, I think every new technology went through the similar phase. As investor, we are very mindful about not to chase every shiny things, but to really understand, what's the ultimate value AI automation can create to the end users. So in this sense, we talk about the enterprise productivity. We talk about how robotics can increase the throughput of manufacturing and the efficiency of warehouse and logistics. And those are real values, and those are real business use case that has concrete ROI. And those are the things that we that can get us most excited, rather than just some sort of a buzzword, according to the hype cycle.
And Jay, going off on this tangent, when looking
Mm,
at being a US China cross-border fund and looking at
mm.
investments, is AI automation really playing a big role in China today, and how?
Yeah, so this is something I I would love to talk about, because I feel like it's not being talked enough, which is the AI automation that's taking place in China. Um, so over the past 10 years, I been travel to China, from either making, for making investments, or, building a BD pipeline for portfolio companies in the US. So I would say, 5 years ago, we already know China has leapfrogged itself in mobile space, because China didn't have a lot of the incumbent or the legacy of credit card payment system, but instead it really kind of get into mobile payment much faster and much more elegantly in that space. And also, there is this huge benefit of having the largest mobile users in China market. So that really foster a new type of innovation in mobile and mobile payment space. Now, with AI automation, I think one big companies everybody talk about, and we talk a little bit about it before, is ByteDance. So ByteDance, again, is a company started roughly 7 to 8 years ago, but with a simple idea, right? How do you use algorithm? How do you use a new type of approach to distribute information in a more efficient way? In that it's not human, it's not people search for information, but rather information search for people. And I think that type of it sounds so simple, but it really represents a huge breakthrough, because it can interrupt or disrupt a lot of big companies in the social media space, such as Facebook, such as search engines, such as Google. So and we're just seeing the beginning of this AI automation that's happening, that's having a really tremendous effect in different verticals. So specifically in China, I think China has some advantage in terms of the abundance of data, and also in terms of the engineering talents. And also, don't forget, like especially in the B2C space, consumer space, China is well known for micro innovation, right? For the ability to quickly adopt what consumers want, so that they can adjust the business model, iterate the product form to make it more suitable. So that's the advantage China has. Now, the next phase of AI automation, or the next phase of AI automation, or next phase of the big unicorn, where is it going to come from? I think it's really going to come from the AI automation space. Again, in both US and China, but in China it has a different focus, or different flavor, because the B2C space is kind of get to the tail end. China already has major tech companies in the B2C space, very similar to the US counterparts. Internally, we have done analysis that, looking at market cap of huge or established B2C companies in the US, combining Google, Amazon, and Facebook, they're equivalent about 4 trillion market cap. But then if you look at China, Alibaba, Tencent, and then now including ByteDance, it's roughly about the same. I mean, it's roughly 2 trillion, but you have that 2x factor. But in terms of unicorn, big company, US has 21 and China had 32 in the B2C space. So I would say, ByteDance is definitely an outlier in the B2C space where they present a huge opportunity. But one thing that we're mostly excited about is the B2B space, because as we discussed before, there are multiple ways AI automation can have a profound impact on different enterprise verticals. And then just to continue the previous thought real quick, on the B2B space, we're really bullish about AI automation enterprise in China is because, again, if you look at the similar market cap of companies, a bucket of companies, Microsoft, Salesforce, Adobe, SAP, or Oracle, if you put them into one bucket and you realize their market cap is about 2.6 trillion. And now if you look at Chinese companies, it's about 100 billion, total together, these public B2B companies. So there is about 20 times of upside for these companies to grow into the similar size of a US counterparts in the enterprise space. And I think with an advantage of AI automation, with some of the underlying conditions that we talk about, cloud computing, talents, and abundance of data, is really going to get China to be on the same par with the US counterparts. And that's why this year we spend a lot of time looking at Chinese companies and thinking about where we can find the next big unicorn that coming from China with that similar thesis.
Yeah, these are some very good points you bring up, Jan, and I'm excited to see how the U.S.-China relationship politically is going to kind of play out with how it affects cross-border venture fund investments.
Yeah, for sure. We definitely, we're cautious, but we definitely optimistic about it as well. I think over the long term, I think collaboration is the part that as human, we cannot avoid and we cannot escape from, right? I think just for every 50 to 100 years, we're just in this big cycle. And I think, if you read Ray Dalio's the book, the changing world order, and he talked about, like, if you look at the world history, the capital history, and also the innovation history, it really rhyme in a frequency about 100 years. So I think over the past 30, 40 years or 50 years, we kind of go through this harmony where it's peaceful and happen to have a globalization trend. And now we kind of get to a point, the swing is kind of going the other way. But ultimately, it's going to be okay. Ultimately, humans collaborate, and and then that's why we're doing what we do, right? We fund innovation, we fund these understanding and the cross-border learning between both sides. Although it's not as big, as any president would do, like signing executive orders, but every little step counts.
Well said, Jay. Now I kind of want to jump into talking about startup founders and how you usually go about advising them. How do you recommend startup founders approach their first few rounds of financing? And which method do you suggest using? Is there a negative in using one method over the other?
Right. So by this, you mean different structure of financing, like safe note or convertible or price round, right?
Yes.
Yeah. So that's a really good question, and frankly, a really practical question as well. So we've seen that a lot, especially founders raise the first round, either let it be a seed round or institutional A. So typically with A round, it's the less common to see companies raise a convertible note because A round you typically want to have a board member. You want to have a price round, and the round size typically to be larger as well. So nowadays, I think the Series A round is quite big compared with what the venture market looked like five to 10 years ago. So right now it's probably like 5 million. That's the typical Series A round. Now, before that, companies usually raise a seed round or angel round. And that's more common when we see a company raise convertible note or safe note before they get to the A. The pros and cons, well, I should say that, it's also not uncommon to see a price round in the seed as well. Now, there are couples of pros and cons in with different structure. The good analogy that I would think about is, because remember, like, why would you want to raise a round from an institutional partner or institutional VC fund? The answer is that you want to look for a good capital partner that can be there for you long term, and can be there for you to raise the next round, and ideally all the way to IPO. So with a safe note or with a convertible note, you don't have that. Now, what you have is that you can say, XYZ fund invest in my company, and you can do that multiple times. You can even have a party round of having 5 to 10 VC fund that invest in your company. But the problem is that none of them gonna have enough skin in the game to really step up and help you. Although when they try to sell you the check, they're gonna say, they're gonna help you, they're gonna be the partner. But the reality is that, if you are a VC, you make $5 million investment in one company, and on the other one you make $100K. Psychologically and realistically, it's just hard to balance the time and attention to those companies equally. So that's kind of like the downside of not having a price round. Now, the upside of having convertible note and safe note is the speed. You can raise those financing typically quickly, and it is really just about supply and demand. If you have enough demand from the capital side, frankly, you can do any type of any form of financing you want, and you have a lot more options. Choosing which method, which approach that you want to go. But if you don't have a lot of momentum and you're just trying to kind of get things started, and you happen to have people, let's say angel investors, individual investors, or some VC fund who want to buy optionality, kind of get one foot in the door and to see what happens. If you have that, then I would suggest probably using a convertible note will be a better approach, because instead of kind of haggling what the price or what the valuation would be for a late stage company, you can just get the check quickly, and then kind of just get the product off the ground and then see what happens. Now, the last note is, as an investor, I always like to push for a price round, and I have a whole reason for it, and that's the kind of the pitch that I would make to the founders. But from the founder's perspective, I think it's understandable that they want to choose different approach or different structure based on where the company is at.
Thank you for that insight, Jay. So, how do you determine a good investment, and what things do you look for in a startup founder?
That's a really good question. A lot of investors got asked that question because different VCs investors have different philosophy or different viewpoint when they think about how to make investments. So for me, I always feel like being an investor is kind of like a combination of being a historian and a biologist at the same time, because you really have to study the history, study the past data point and the past trend to understand the present and the future. And the other thing about kind of being a biologist is that you kind of have to see companies or see different market trend, kind of like a living organism, because it keep evolving. And especially for market analysis, it's very similar to nature's ecosystem, right? It's noisy. It has a lot of players in the space. It has a different push and pulls. So I think so that's my philosophy. That's my viewpoint. Of other areas that we can draw insight when we look at attractive business opportunities. Now, to answer your question more specifically, there are 3 points that we focus on, or that we pay a lot of attention to. The first one is the market. So Don Valentine at Sequoia Capital if you look at watch his past video or hear his talk, he insists one thing and one thing only, which is the market size. It's not about the founder, it's not about the product, it's not about anything else, but it's really about the market. Is the market big enough, or is there a big underlying trend that's going to unfold in the future? And I think there is really profound meaning behind it, because for each investment that we do at a VC stage, it's just really about one is about long term, and two is about creating value. And you cannot create value or value large enough if you are not investing in a big market, a big trend that's going to become a big market. So that's the one criteria that we think a lot about. Again, kind of joining to the analogy with nature, with history. The market size and the future market trend is something that certainly for us, investors spend a lot of time focused on and frankly meditate on. Right, you have to have a clear mind and independent thinking on the first criteria. Now, the second one is that the product side. So once we're convinced this is the big market, the sector that we want to get involved, then the second thing is how do you create value, or how do you solve a problem within that market? And this tend to be very tangible, because when a startup approach you, or when a company approach you, they already have a product, or at least have a product idea in mind to solve that real problem. So that part, we will try the product, we'll use the product, we'll get some reference along the way throughout due diligence from the customer's perspective. But that's a second supporting criteria when that we use when we think about investment. Now, the third part, last but not least, is the team and founder. So if product represent what that company is now, or from the past, because it takes time to build the product to where they are now, then the team and founder, that people component, is really what's going to happen in the future. Because if we believe in the market, we believe the product that's in a good position to enter into the market. Now the team and the founder is the part where we have to build our conviction to say that's the people, that's the type of team that we're willing to back, that will carry this mission of this company forward into the future, and therefore build a big company. So in a way, it's not that complicated. Market, product, and team. Those are three big framework that we use when we evaluate investment opportunities.
And Jay, to wrap up our call with the last question here. So Jay, to wrap up the call with our last question here, what piece of advice would you give to the people out there from the journey you've had thus far in life, in regard to both entrepreneurs and VCs and people looking to pursue that realm?
Yeah, thanks for the question. So for the first part, the entrepreneurs, I myself was entrepreneurs before, and I know it's a tough journey, it's a lonely journey, and it's really not, it's not a path that can be easily chosen and stick to. So I can relate to that. But on the other side, if you're an entrepreneur, and it's easy to get discouraged, because you're gonna face a lot of no's. At the same time, I would try to answer this question a slightly different way, which is knowing what I know, and having done the things that I have done, kind of what do we look for in the founders that we back? I think the number one thing is the resilience. The ability to not give up, or the ability to continue to push forward when they face multiple rejections. So that's one thing. I think one of the top quality that we look for in future founders. And the second thing is it's to have a vision. It's really to have a vision, and I think that applies to both founders and investors. I think too often investors are being labeled as kind of being too opportunistic and too much of a kind of hit driven. You kind of chase every new shiny things. But as a founder, I think vision is super important. I mean, you can read different kind of stories about how big companies got created. Apple and Alibaba. And I think there is some truth in those early origin stories, in that these founders, they have a really clear vision, and they're able to articulate that in a way. It's not about them. I mean, it's not about that. Jack Ma, one Jack Ma individual, or one Steve Jobs, but it's about their seeing the future. That for in Alibaba case, there is no business that can cannot be done, globally. So that's kind of like their slogan and their vision, and they kind of go after that. So can a founder articulate their vision and their viewpoint really clearly? That's something that we want to pay a lot of attention to, and that's kind of the advice that we give to founders. Now, to VCs, or to aspiring VCs, I think the part is the advice. Let me put it this way: the advice I would give to myself early on, or before I kind of get into the path of VC, is just really to remain the curiosity that you have. Because in order to be a good VC, you really have to remain curious all the time, and be humble. Because in this industry, it's hard to remain both, right? Because you are equipped with capital, you're equipped with checkbook. So not being complacent is one of the kind of the basic criteria, for a good VC. Now, being a great VC, that takes something else, such as hustle, the ability to hustle, the ability to be more proactive, and also, frankly, some luck in it as well. But to sum up, those are the kind of like high level thoughts that I can think of right now.
And Jay, for people who are interested in reaching out to you, what would be the best points of contact?
Yeah, for sure. So people can follow me at my new newsletter. I recently started a newsletter called the Next Trillion. So if you search Next Trillion Jay Zhao, or nexttrillion.substack.com, you can subscribe to my weekly newsletter, where I share my thoughts and some updates. That might be the best way. And also, obviously, people can find me on LinkedIn, just with my name, or on Twitter as well. So yeah, I mean, I think right now we just have so many ways to stay in touch with each other. But probably newsletter is the best way.
Jay, it was a pleasure having you on Geeks of the Valley, and thank you so much for joining us.
Thank you so much. It has been great.